Hlavin is Managing Director and Portfolio Manager at Nuveen. As a member of the High Yield Municipal Portfolio Management Team, he's responsible for supporting all high yield municipal strategies and is specifically responsible for managing the Enhanced High Yield Municipal Bond Interval Fund, several high yield municipal closed-end funds, along with Nuveen's flagship high yield municipal bond strategies. And you began your career with Nuveen in 2003. So
correct, yes.
It's been a while. So Nuveen manages $191 billion in municipal strategies. There's 28 listed closed-end funds, high yield municipal interval funds. We talk about the difference between those and how you use those in portfolios.
Yeah, investors use closed-end funds and now a new iteration in the interval fund to access different areas of the municipal bond market. The primary objective of all of these is income. Mm-hmm. And income can be magnified through the use of leverage. That's a common construct in either of these funds. When you create a portfolio that includes high yield municipal bonds, then you are now able to not only produce more income inside the portfolio, but have more credit spread to leverage in that type of wrapper.
Mm-hmm. And then these have received an annualized total return of 12%. So that's where the high yield comes in, I guess. That's double the return of the S&P 500 Municipal Yield Index. So how do you know, because when I think high yield, I think higher risk. How do you know what's a good prudent investment?
Yeah, the 12 plus total return is capable in something like a high yield municipal interval fund, where we're getting that higher embedded yield and we're able to leverage that with that product wrapper. The interval fund also does something about arbitraging the growing liquidity risk in our market. So there is a liquidity risk component that we are also monetizing. And what's driving that total return, the majority of that is income, is the embedded yield, and that yield anchors such returns. We can get additional NAV or price return when credit spreads compress or active managers are contributing active credit selection to the portfolios.
Okay. What's your outlook for municipal bonds, high yield bonds for 2025?
Well, after an unprecedented amount of outflows in 2022 and 23, and the subsequent credit spread widening, we're finally starting to see flows come back in. Confidence is being restored. We are seeing good fund flows, consistent fund flows as reported by Lipper. But the flows that we've seen so far are still a fraction of the amounts that we saw come out of the market. So our outlook is for continued flows into municipal mutual funds and other products. And so as long as that continues, we are on a positive and upward trend in terms of not just high yield returns, but also those NAV and price returns on top of that.
Some of them are tax favorable as well, so you're getting a lot of benefits there.
When you look at the taxable equivalent yields on some of these products, particularly our high yield municipal bond interval fund, that's, I think, what is driving a lot of the attraction.
Okay.
Because when you're looking at a dividend yield of roughly 5.75%, the taxable equivalent is pushing 10%. So where can you find 10% taxable yield with a type of default risk and credit risk that's managed through a municipal bond portfolio?
Interesting. Now we've got a new administration in Washington that's federal, but do you anticipate that having any impact on the municipal bond market?
We think that the impacts are going to be sector specific. The idea of eliminating the tax exemption is a very difficult thing, I think, to push through because of the cost and the burden that it passes on. When you get down to the detail and allow an intelligent conversation to happen, it's very clear that this is a massive and punitive tax on state and local governments, and would be a negative impact on the economy. Where we think that the impacts are going to be, or possibly in sectors like healthcare or higher education, would have some possible negative impacts, but we could also see positive impacts too. That's the other thing, is that policies could have positive impacts in sectors that would be utilities and energy, but also charter schools might actually see greater enrollment decline as more states and more communities adopt free choice.
Yes, and the vouchers, I know that that's been proposed in a lot of different legislatures for that.
Yes,
so,
exactly.
Okay, so anything else on your radar screen for 2025?
We look, again, for that continued flow into the market, and that's going to put downward pressure on credit spreads. And there's a lot of room still to go. We have not even come close as a market to getting back to where credit spreads and relative valuations were at the end of 2021 before all the outflows started. And we just have to remind ourselves just how unprecedented those outflows were in 2022.
Is that a COVID related?
No, this was post-COVID. This was just a violent reaction to interest rate volatility that folks have not seen in decades.
I see. They're starting at the beginning of the Fed raising rates.
Yes, and so now that we are in a more stable rate environment that's offering higher yields, we are now starting to see those flows come back into the market.
Okay, Steve, thank you so much for sharing your knowledge with us.
Thank you very much.